Hi, this is the Philosophical Angle program, and I am your host, Chris Angle. Along with me is my co-host, Rick Samuelson, a venture capitalist on the West Coast. Good to see you, Rick.
Good to see you.
The purpose of the Philosophical Angle is to analyze the nature and concepts of what's happening in current media. But once a month, we have a special show, a program on the health of the U.S. economy, and from it we make a prognostication of the direction of the U.S. stock market. This outlook is generated from the RITE Report, spelled R-I-T-E, and with this report, this month it says that stocks are a hold. Okay, let's see why. Let's drag up the report and let's go through it a little bit. First of all, the report takes the headlines from the Wall Street Journal and some other sources, such as the Bureau of Economic Analysis, and it adds them up and makes an index out of the news to understand whether it's a positive or a negative bias that are being received by investors daily from the Wall Street Journal. So let's go through some of these headlines that the RITE Report adds up. And we notice right off the bat here, ExxonMobil profit tumbles 58%, and we can expect to see throughout our listing of the headlines here, a lot of the energy companies have been hurt. Spectra Energy swings to a loss. Marathon Petroleum slumps on big inventory markdown. Apollo Global profit tumbles. And not only does it affect the fracking and the surplus of energy affect the energy companies, it also affects commodities worldwide. Noranda Aluminum files for Chapter 11 bankruptcy. So in the energy industry, there's a lot that's weighing on the growth of energy, and really it's going into a contraction, it seems, and profits are surely down for the sector as a whole. But there are, of course, not just the energy sector. As you can see, there are many headlines of other types of companies that that were negative this month. Prudential earnings fall and higher spending. Here's another commodities. Rio Tinto swings to annual loss. Here's a Paragon Offshore files for Chapter 11 bankruptcy. Here's another insurer, Canadian insurer Manulife, profit hit by energy charges. Oil price fears weigh on European banks. So global banks shares tumbled last week on investor fears about global growth. Another commodity, Anglo-American chief woes set to deepen. It's even hit some retails. Nordstrom reports tepid holiday quarter results. Hopes dim for Walmart's effort to ignite growth. And the banks, yep, a lot of banks are down. Deutsche Bank policyholders avoid buyback. And another Standard Chartered reports first annual loss since 1989. So the list is, there were quite a few snippets from February, 52 in total, and that's comparatively a fairly high number. But on the other side of the ledger, let's go over some of the positive corporate news snippets. And GM, profit lifted by China, US. Well, as you can expect, the lower energy prices produce some really good bargains out there for companies that benefit from a low energy price. So although on one hand the energy industry has been hit, those benefiting low energy are coming up, and we can afford to more than double Mexico production capacity in 2018. Airlines have been doing well. Spirit Airlines profit surges on cheap fuel. Hotels are doing well. Wyndham expects strong 2016 revenues, boost dividend. JetBlue Airways forms technology unit. Here's an insurance company that's doing well. Sun Life Financial tops analyst estimates. And UPS named new chairman, boost dividend. That's a good sign that shipments are doing well. And Time Warner outlook looks solid. And here is another French Renault profit jumps despite Russian loss. So the car companies certainly are doing well. And so are the hotels. Here's Marriott, Hyatt. Retail seems to be doing pretty well. Macy's tops estimates. And here's an interesting one. Maersk Line sees improving Asian European demand on retail restocking. That's important because, of course, container ships, when they do well, it's usually a good indicator that the world economy is doing well. Airbus boosts production. Another retailer doing well, JCPenney doing well, and this is probably because income is rising for the American consumer. And so let's go down here and see. So yeah, it was only 43% positive and 57% negative on the corporate headlines. But let's go over in detail some of the macroeconomic events that were listed in the Wall Street Journal. Some of the negative stuff. China manufacturing gauges add to sluggish economic picture. Yeah, we all know that the growth is de-accelerating. And it hit the stock market when that news was around in January in particular, and although it's come back somewhat. Personal consumption expenditures decreased 0.7 billion, or less than 0.1%. Productivity decreased 3%. U.S. exports of goods and services decreased on a yearly basis 4.8%. Big companies pull back after a rough quarter. Strong dollar, slumping stocks lead to cautious capital budgets. Some firms plan layoffs. Here's something interesting. Slowdown in funding takes bite out of India's startups. Investors in India's tech startups are becoming more discerning and tight-fisted. As a result, startups raised almost $1 billion in the final 3 months of 2015, roughly half of what they said they raised in the last quarter of the previous year. That's in the positive section because although it seems to have a negative slant to it, India's growth is accelerating and over now 7%. So a lot happening in India. It seems to be replacing China on the front page of growth estimates. Nobody likes the Obama economy. Economists lower growth estimates amid rising recession risk. Japan's economy contracts again. U.S. consumer. Here's something I should. It sounds like that should be on the negative side. It's the world's third largest economy contracted for a fourth time in 7 quarters. A lot of problems there, it looks like. U.S. consumer sentiment slips. Canada retail sales plunged 2.2% in December. And there's obviously a commodity slump. And trucking demand slipped in January. And as we already mentioned, China's slowing down too. China manufacturing slows more than expected. U.S. pending home sales tumbled 2.5% in January. However, on the positive side, we mentioned that there's an increase in personal income, and sure enough, here it is. Personal income increased 0.3% in December. Nominal personal consumption expenditures rose 0.1%. Personal income rose 4.5%. The personal savings rate was 5.2%, and ADP reports stronger than expected January payrolls. U.S. sector service expands in January. U.S. Secretary of Commerce. Many service sectors increased exports in 2015. Now here we go. India's economy expanded 7.3% last quarter. The country is ahead of China as the world's fastest growing major economy. Home price growth sped up last year, realtors say. Oh, here's something interesting. What slowed down? Chinese consumer confidence still strong. Okay, good. Jobless claims are falling, and U.S. home price growth picked up in December. Maersk Line also sees improving Europe demand. Real gross domestic product increased at the rate of 1%. At least we've got growth. Personal income increased 0.5%. We might have already, I don't know if we already said that. And the personal savings rate, 5.2% in January. And U.S. economy starting 2016 on a solid footing. Some of the economic headlines, positive ones from the Wall Street Journal. Mergers and acquisitions were down this month, only totaling 13. So the percentage of positive news this month in February was 59%, pretty strong, although the merger and acquisitions were down. So let's go over all the major indicators that the RITE Report uses to prognosticate the market. Real GDP up 1%. Unemployment overall, it's positive. It's only 4.9%. Unemployment rate, the civilian labor force participation rate ticked up 1/10 of a percentage point. Employment population ratio also ticked up slightly. And the employment trends index is positive this month. This is a very important one. Industrial production index. It went up. It had been going down recently, but it's reversed and gone positive. It's put out by the Federal Reserve. Very important statistic. The PMI contracted though. It said that the economy contracted 0.5 point negative. Sales, retail sales is positive, went up. Consumer spending is up. Personal income notched up. Consumer confidence is, however, declined. Housing starts were negative. Existing home sales were up 0.4%. New residential sales are down. We're down drastically, 9%. Construction spending up 1.5% positive, and manufacturing trade inventories were up 0.1%. Manufacturing shipments are down negative 2.9%. Advanced report for durable goods, real strong, up 4.9%. And the quarterly financial report is positive for the third quarter. The fourth quarter, I think, are coming out later this month. However, profits from current production is negative. And the leading economic, the Conference Board put it out as a group of leading economic indicators. It came out negative this month, but the coincident economic index was positive. Their measure of CEO confidence was negative, and junk bonds were positive this month, which is a great sign. And the select dividend stocks were also came up this month and were positive. Kind of an interesting index that we use here is the Restaurant Performance Index, and it's expanding slightly. So overall, we have positive 15 indicators, negative 8, and 0 neutral. So it was fairly strong for a forward-looking economy that will. So we think that stocks are going to continue upward. But let's get the other side of the story from Rick and see what his thoughts are about the economy. Rick?
Yeah, on the negative side, last year, according to GAAP earnings, earnings were down over 10% last year. According to pro forma calculations, which is how corporations massage their earnings, they were down between 2 and 3%. Corporations broadly in the United States are actively massaging their reporting to make it look as positive as they can. The consensus is moving quite dramatically in the first quarter for analyst earnings forecasts, but my guess is for this year we'll end up somewhere between 10 and 15% negative growth in earnings for the United States. So on that basis, the stock market, if it does nothing at all, and year to date it's just down a little bit, so it's effectively done nothing at all, is getting more expensive. And that's the central problem for, I think, the U.S. stock market. I don't think anyone truly believes the earlier forecast that the U.S. Economy is going to grow at 3% this year. I think, if they were to be honest, there'll continue to be downward revisions as we've seen every year for the last 7 years, without exception, for both the U.S. economy and the world economy. It's just a matter of catching up with the downward revisions over the course of the year. They sort of start every year with a forecast of 3 to 4% growth expected, and then by the end of the year, it's somewhere down closer to 2 or less. And I expect the same thing's going to happen this year. So I think the more important issue in terms of determining where the stock market's likely to end up, whether it's really going to go anywhere this year and just be choppy all year long, is where the earnings forecasts end up. I think there's a more interesting divergence between sectors and what the potential is there versus the stock market as a whole. There may be a case, for example, for investing in the energy sector now. I think all the negative news on oil prices is out there. it's hard to imagine oil prices are going to fall to $10 a barrel or something. So chances are oil prices will be flat or up going forward. And so you would think that the energy sector, and also I think the U.S. has cut about a third of its production in the fracking areas already. And so even if there is still some oversupply worldwide, it's not inconceivable that you could see supply and demand over the course of this year finding a better balance. And in that case, the energy sector, which is so beaten down in the United States, might have the greatest outperformance of any single sector in the U.S. stock market. And similarly, if you look at the emerging markets, they've had a pretty positive run in the last couple of weeks. I think they're up 8% or so in aggregate. They are so beaten down, and the currencies are so beaten down that I think any snippet of good news out of the emerging markets would justify, pretty powerful outperformance relative to other asset classes. So, and particularly the currency potential. And it's obviously true that if the United States were to raise interest rates while the rest of the world continues to go negative, it's hard to imagine that the U.S. dollar is going to fall anytime soon. But even if the U.S. the Federal Reserve were to raise interest rates 25 basis points by mid-year and another 25 by the end of the year, you'd have to imagine that a lot of the bad news in the emerging markets and the good news for the U.S. dollar is priced in. So even if the U.S. dollar were to rise another 10, 15%, the worst phase for foreign currencies is basically over, because if you look at Asian currencies, outside of China, they're down between 20 and 30%. The Canadian dollar's gotten hammered, down 25% or more. The Australian dollar, the euro, there's just been carnage across the world in terms of currencies relative to the U.S. dollar. Basically, the U.S. dollar's, far and away the strongest world currency. And so anyone who believes in kind of a reversion to the mean over time has to think that any good news on the fundamentals of emerging markets or other stock markets outside the U.S., combined with, finally a flattening out of the U.S. dollar within the next year or so, would think that, maybe it's time to jump back into foreign markets or take them a lot more seriously than investors have. I think investors have pulled out record amounts of money out of emerging markets, billions and billions of dollars, just in the last several months. So in terms of stock market strategy, I would be looking very seriously over the next 12 months at the energy sector in the United States and elsewhere, and also foreign stock markets, particularly the emerging markets.
Okay, pretty interesting. So a good sector to invest in going forward would be the energy market.
Yeah, I think it may fall a little bit more. Who knows what's going to happen. Very hard to predict oil prices, but is it going to fall in half? It's hard to believe that. The same applies to selectively to energy bonds. It's hard to imagine that the spreads are going to widen that much more on energy sector bonds. Admittedly, there's bankruptcy risk, and you got to be careful. But some of the bigger players, are they all going to go bankrupt? I don't think so.
Maybe it's a good time for looking to consolidate the industry, where the large pick up bargains of those that are failing.
Right. It's definitely right for consolidation. Yes.
Say, you mentioned that stocks are getting expensive. You were talking about the stock market almost coming back and really being even for the year so far. But then you mentioned stocks getting expensive. What did you mean by that?
Well, if the earnings are falling, then the price earnings ratio is rising, even if prices don't do anything.
Okay. And you were talking about the strong dollar. What do you think the driving force is of the strong dollar?
Fed policy. You know, you have the Fed on one side. It's basically the only major central bank that has raised rates, even if only slightly. And everyone else, Japan, Sweden, European Central Bank, and others have already gone negative, which poses its own risks. I think it's nutty, and it won't work.
And so
And
overall,
the Federal Reserve doing the same thing. I mean, that's why I think Larry Summers was suggesting that we get rid of $100 bills, right? Because what are people going to do? They're going to put money in their mattress. They think, they'll be charged to hold a savings account.
right, right. So overall, what do you think for the direction of the stock market as a prediction here?
I think it's going to be very choppy all year long. I think the risk remains on the downside because of falling earnings forecasts. And it's not just the energy sector, it's broader than that. And so I think you have to pick your sectors quite carefully, pick your stocks quite carefully. And it's probably a good time to be going long short and selling off companies that are going to fall or continue to fall, and buying into companies and sectors that have a chance to come off of really serious declines, like the energy sector.
Okay. Rick, I want to thank you for your prognostications here today and on the philosophical angle. And we'll see you all next month for another view of the stock market. Thank you very much.
Thank you.